Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, so make a start. So last week we started valuing options, right? We used the binomial option pricing model, and that was our two-step tree. You either went up the tree or you went down the tree. We spoke about the probabilities of moving up or down. We calculated the payoffs at the end, and therefore we said, just like you did in Foundations of Finance, the value of any financial asset, so in this case, the value of the call option premium or the put option premium, is just those payoffs. So that's your payoff at the end, taking into account the probability of getting them and discounting them back to time zero. Okay, so that was a two-step binomial tree, and we use that mainly for valuing American call or American put options, because you've got that early exercise decision. You can choose to exercise early on either step as you go up or down the particular tree. Today's option pricing model we're going to look at, Black-Scholes, is mainly used for valuing European options, so where there is no early exercise. And the premise behind this model is pretty similar to last week's. You'd replicate it by setting up a riskless or risk-neutral portfolio. Okay, we don't go through a derivation this week, but essentially the premise is that you set up a portfolio where we know that call options, the price of call options, are perfectly positively correlated with the underlying stock. So as the stock price goes up by $1, well, the call option premium should go up by about $1 as well, because you get an increased payoff of about $1. And with a put option, it's the reverse. Okay, they're negatively correlated. So if the stock price goes up, right, then your payoff goes down, okay, by a similar amount. Okay, take into account all those other factors that we speak about. So what's important about Black-Scholes is it's just one nice formula that you can use to value, but there's a few assumptions behind it. And one of those assumptions is that stock prices follow what we call a log normal distribution. Okay, so what does that actually mean? So if you remember in Foundations of Finance, when you spoke about risk, what you're worried about was, I guess the main moments was expected return and standard deviation. It was working before. Okay, so we spoke about in Foundations of Finance, all you care about is your expected return and your risk, okay, risk and return. You didn't worry about the other moments, things like skewness and kurtosis, because you made the assumption in Foundations of Finance that everything followed a normal distribution. Okay, that's obviously a lie. Okay, everything does not follow a normal distribution. So this is a normal, it's going to look bad because I can never draw these, but that's really bad. Imagine that's a nice bell shape. That would be a normal distribution. That's not what stock returns look like. Okay, stock returns look more like this. Okay, because obviously you're bounded at zero. You can only lose, if you like, 100% of what you invest. Okay, so the maximum loss you can make, we have limited liability is the amount of money you spend on a share. So 100% loss is the maximum loss you can make. And then obviously down here, so if this is return, down here you can make huge gains up here, 100, 200, 300, 400%. There's no bound to the gains you can get down here. So the great thing about this, though, is this is actually what we call a log normal distribution. It's a distribution where prices are skewed to the right. Okay, so what we normally should care about, so expected return or mean, standard deviation. So these are the things you're worried about in Foundations of Finance, risk and return. But there's other things. There's skewness. So that tells us how spread are we down in our tails. Obviously, this is very skewed to the right. and we have kurtosis, right? And kurtosis tells us how peaky or how high things are. Now, we tell you in Foundations of Finance to ignore these. And the great thing is I can tell you today as well to ignore them. The reason being is when you have a log normal distribution, if you take the natural log of that series, you end up with, surprise, surprise, a normal distribution. So taking the natural log of a log normal distribution gives you the normal distribution such that there is no skewness, there is no kurtosis in the resulting values. So we're back into that world where all you care about is mean and standard deviation. Okay, so you'll notice in our formula today for Black-Scholes, we take the natural log of all of our stock prices and all of our returns. So taking that natural log brings us back into a normal distribution world. So you can read our distribution tables and you can go back to that Foundations of Finance world. So we take the natural log and that brings us back to, again, I can't draw these. Actually, that's pretty good. Okay, our normal distribution. Who remembers from your first year stats course, either 1008 or 7055, what assumptions can we start to make if we have a normal distribution? How many values lie within about one standard deviation of the mean? Wasn't that long ago. Who can remember? 6, fantastic. So about 65% of values lie within one standard deviation of the mean. So that means if this is the mean, right, then if that's one standard deviation, about 65% of the values lie within this space. And within about 2 standard deviations, how many values? About 95. So about 95% of values lie within it's 1.96, but about 2 standard deviations of the mean. And that's great in something like valuing options, because now we can look at probabilities or the likelihood that the stock price will be either above or below the exercise price. That's obviously going to matter because if it's the probabilities of it being above or below the exercise price gives you the probability of the option being exercised. Right? So that's what we care about. Looking at these distributions, where are we likely to be? Above or below? What's the probability we'll be above? That is the probability a call option will be exercised. 1 minus that probability is the probability that the put option will be exercised. Okay, so those are the things we start to think about. And we can do that now that we've got this in a normally distributed world by taking the natural log of our spot prices or our returns. Okay, so that's where we're going to get to in about 10 to 15 minutes' time. What we're going to look at now, though, is we're going to look at something that's not examinable. Okay, so it'll be in your tutes after the break, but it's not examinable. It's an extra 5 or 6 formulas I don't think you need to learn. Okay, but it is going to tell us something about this idea here about distributions, where we think prices might end up, but it's not looking at necessarily the probabilities of the likelihood of exercising options. So just to reiterate, anything under topic 1 of today's lecture is not examinable. Okay, we start examining at topic 2. Okay, so this is the log normal distribution we looked at on the overhead a couple of minutes ago. And as I said, the great thing is when you take the natural log, you end up with a normal distribution. So we're back in that Foundations of Finance world. So here are the formulas you don't need to know. You'll have them in your tute. You won't be quizzed on them. You won't be assessed on them. Okay, it's just good to know the idea behind it though. Okay, so the mean of ln of st. So that is, what is the mean spot price at the end, but taking the natural log of it. Okay, so what could we expect the natural log of the spot price to be at the end? Okay, and it's going to be the natural log of the spot price today. So S0 is the spot price today, plus mu, the thing that looks like the letter U. Okay, that is my expected return. So what's my expected return on this stock? Minus sigma squared, so my standard deviation squared, or variance, divided by 2, multiplied by the length of time I'm looking at. So I'm wanting to work out the natural log of the spot price in 6 months. That would be 6 on 12. 1 year, t would just be equal to 1, just like we've done all through the course. Then the volatility of the natural log of my spot price is just standard deviation times the square root of t, the time I'm looking at. Is it 6 months? Is it a year? And then that gives us a distribution. Okay, so the natural, the natural log of the final spot price, I don't know why it should be a little tilde, but it hasn't worked for some reason, should be distributed normally because we've taken the natural log, so the n means distributed normally. Hopefully you've done this in your stats course, where this is your mean, okay, so your expected final value, and then after the comma is your standard deviation, your risk. Okay, just what we see above. And then if we want to find the expected value, what do we expect the final spot price to be? Well, it's going to be the spot price today multiplied by e to the value of mu, which is your expected return, times t, where mu will be continuously compounded. So it's just what do you expect the return to be. So if your expected return is 10%, all you're doing is saying, let's give it 10% growth. Okay, kind of makes sense. You'll notice there's no natural logs there. Okay, this is out of the natural log world. This is just telling you what do you expect the final price to be. And then the variance, okay, so the standard deviation squared will be equal to the spot price today squared multiplied by e to the power of 2 times the expected return times the length of time you're looking at, multiplied by e to the power of standard deviation squared times 2 minus 1. Okay, so isn't it nice? I'm not expecting you to learn these formulas. Okay, don't need to know them. Okay, you might need to use them in your tutorial, but not in a quiz. Okay, so let's have a look at some questions. Find the probability distribution. So that's going to be this one down here. This is our probability distribution of the stock price in 6 months. So my T is going to be 6 on 12 for a stock whose current price is $50. So S0 is 50. Expected return, that's my U, my mu, the thing that looks like the letter U, which is 20% per annum, and a volatility of 30% per annum. Okay, so 0.3. So we just plug them into the formula. So this was our formula before, the one down the bottom. Now we're just plugging in those values. So it's going to be normally distributed, the natural log of the current spot price of $50 plus my expected return of 20% minus my risk of 30% squared divided by 2 times a half, that's my t, the length of time I'm looking at. So that's going to be my mean, and then comma, I look at my standard deviation. That's the risk of 30% times the square root of half a year. Plug that into my calculator, gives me 3.99 or 0.212. Okay, so my risk is 21.2%. Over that 6-month period. And then my mean is 3.99, which means nothing, because it's the natural log. So if I actually wanted to get the value, I'd have to reverse it out. So I would say, if you like, e to the power of 3.99, that would give me my expected value. But here I'm doing a probability distribution, and here I want to have a confidence interval, if you like, of 95%. So I want to say, what range will 95% of the expected stock prices, if you like, in 6 months' time lie between? As we said before, about 95% lie within 2 standard deviations of the mean. We'll be too precise, it's 1.96 standard deviations of the mean. So your lower range is just going to be your mean of 3.99 minus, so we're finding the left-hand side, 1.96 times my standard deviation, which is 0.212. That gives me my low side. Then the lateral log of the stock price gives me my middle point, and then that's going to be less than the high, so the top 95%, which is again going to be the mean of 3.99, but this time plus 1.96 standard deviations, and again the standard deviation is 0.212. That gives me nothing I can use. Okay, it doesn't really give me anything. I want it in dollar values. So that's why I say e to the power of all that junk. Okay, e to the power of all that stuff will give me it in a dollar value. So on the low side, I've got $35.676, and on the high side, I've got $81.902. So this tells me that 95% of the possible values for this share lie between $35,676 and $81,902. Okay, that's where 95% of the values lie between. Are there any questions on that? And then in terms of finding possible final values, we just go ahead and use these two formulas here. So expected final spot price will be the $50 today multiplied by e to the power of our 20% expected return times half a year, which gives us 55.259. And then the bottom formula is my standard deviation, spot price squared, e to the power of 2 times expected return of 20% times half a year, and then in brackets, e to the power of my risk, my standard deviation of 30% squared, times half a year, minus 1, to give me 140.546. That's the variance. You'd find the square root to give you the standard deviation. Okay, so the standard deviation is about $12. Okay, so that gives you a range, about $12 within that particular mean. Any questions? So probably what I shouldn't have done is said this was not examinable because you probably don't care so much. Okay, but this just gives you an idea of some of the things you can use. Okay, so now everything from here is examinable. Okay, so volatility. Volatility we really care about. And just like with the binomial option pricing model, we could have used overall volatility, which was e to the power of the volatility times the square root of how long the time step was. Right, that's what we did last week. When you're calculating volatility for a particular stock over a period of time, you say the standard deviation, which is going to be an annual number, so what's the annual volatility for the stock, divided by the square root of the length of time you're looking at. Is it 3 months, so 3 on 12? Is it 252 days, 252 on 356? Okay, what is that volatility over that period of time? So, stock's current price is $70. Volatility is 20% per annum. Calculate a 1 standard deviation move in the stock price in 1 fortnight. So a fortnight is 2 weeks. So 2 on 52, or 1 on 26. So the standard deviation is going to be my current volatility of 20% times square root of 1 on 26. There are 26 fortnights in a year to give me 3.922%. So over the next 2 weeks, I can expect volatility or standard deviation to be 3.922%. To work that out in a dollar value, I just take that current spot price of $70 and multiply it by the 3.922% to give me $2.75. Okay, so if you like, over the next fortnight, I can expect prices to deviate by that amount under a standard volatility world. So it's really important, whenever I talk about volatility, I'm talking about standard deviation. Okay, I'm not talking about variance. So volatility in this course is standard deviation. Okay, so sigma, not sigma squared. That is variance. Okay, so for me, volatility is standard deviation. Okay, volatility is hard to think about. Standard deviation is very easy to think about. Okay, you get a nice percentage. Okay, you don't get a big number. Okay, so here are our assumptions for Black-Scholes. They're pretty similar to what we've done in the course so far. There's nothing too new here. Okay, so stock prices follow essentially this log normal distribution. That's fine. Again, like before, there's no transaction costs or taxes. In this example today, well, beginning of today, there's no dividends. Riskless arbitrage opportunities, there are none of those. Security trading takes place continuously, so continuously compounded interest rates. We can all borrow and invest at the same risk-free rate, and the short-term risk-free rate of interest is constant. Okay, so that's the big thing here. Okay, we're keeping interest rates constant over the life of the option that we're looking at. Okay, which maybe isn't completely reasonable. Okay, but that's the basic assumption. So today we look at a non-dividend world, and at the very end we look at introducing dollar values of dividends. After the break, we'll have a lecture on dividend yields and stock indices. We'll have another lecture on futures options and how we value those. So those of you who've been preparing for your mid-semester exam and sending me emails saying, I don't know how to do these futures options. I don't know how to do these index options. Well, we haven't covered it yet. Okay, so you're looking at final exams. Of course, it covers content we haven't looked at. So don't worry about upper and lower bounds for futures options and dividend yields. Just do what we've covered, right, which is in lecture 4. Okay, if you get worried tonight when you're studying for tomorrow. Okay, so as I said at the beginning, we don't do a derivation of Black-Scholes. Those of you who are really keen, I don't know why you would be, but if you are really keen, you'll do that if you go on and do something like continuous time finance, if you're an actuarial student or a quantitative finance major in the undergraduate degree. Okay, but save it for then. If I did it here, I'd lose 90% of you. So we don't do it, it's not examinable, we just use the formula. So like I said at the beginning, all we do is we set up portfolios where we have a position in an option and a position in the underlying asset. Hopefully for all of you sitting there, you go, that's what happened last week. Right? Remember we solved for delta. How many shares did I need to buy to correspond with my option such that if I went up or down the tree, the value was the same. Same thing today. Okay, but there's a lot of math, so we don't do it. Right? You set up a position in the stock and the option, right, such that no matter what happens to prices, and there's lots of things that could happen to prices, you end up with the same value of your portfolio at the very end. Okay, that's the basic step that you would take. Okay, so here is our formula, right? Here is our Black-Scholes formula. So the good news. Here is the good news. The good news is you get this in your final exam, right? This is a page from a final exam, right? You get this formula. You get one formula in your final exam, this one here. So you get the base, it's up on, you don't need to take photos, it's up on Waddle, right? I've already put up there for the whole semester. So, I don't know what's with our document camera today, sorry. It's not. There we go, it's a bit better over this side. Okay, so you get that formula in the final exam. That is what I call the base Black-Scholes formula. There's also ones for dividend yields, indices, currencies, and futures options. You don't get those. You need to know how to make changes to those formulas. But it's really, well, I think it's simple. Okay, and I'll show you how to do that in the next 2 or 3 lectures. Okay, but you get the base one, and then for futures options, for currencies, you need to know how to make changes to the formula. Okay, but you do get this in the exam, and you also get the distribution tables. Obviously, I don't expect you to memorize those. Okay, but here is our formula. Right, so C is going to be the price of my European call option premium. P is going to be the price of my European put option premium. Okay, so again, I'm just trying to find out how much does the call option cost, how much does the put option cost. Okay, so what's the call option premium and what is the put option premium? Okay, and I use this formula to do that for Europeans. And it is, so for the call option, S0, so the current spot price today, multiplied by ND1, we'll talk about that in a minute, minus X multiplied by e to the power of negative RT, so the present value of X, multiplied by N of D2. What does that look like? Looks like a couple of things in my mind. What's one of them? Looks like the payoff, right? Looks like the payoff for a call option, right? The payoff for a call option is ST minus X. Present value, I get S0 minus XE negative RT, which was the lower bound, remember? It was the lower bound a couple of weeks ago from the price of a call option. Okay, so that's what it is. Except we need to talk about what ND1 and ND2 are. For the put option, it's XE negative RT, so the present value of X, multiplied by N of negative D2, minus S0 times N of negative D1. And again, that kind of looks like the lower bound for a put option, right? Or the payoff, X minus ST in present value dollars. So, what you need to do, the main thing, the hardest thing, and it's not too hard, is solve for D1 and D2. So D1 and D2 are just some preliminary calculations. N of D1 is you find out what D1 is and you look it up in a distribution table. So n of D1 is going to give you a probability, which we'll talk about in a minute. N of D2 will also give you a probability as well. So to calculate them, you've got your formulas there. D1 is the natural log, so there you go. We've taken the natural log of our log normal distribution, so now we're in a normal distributed world. So you can look these values up in probability tables. So it's the natural log of the current spot price divided by the exercise price, plus the risk-free rate of interest, plus standard deviation squared, divided by 2, and all of that gets multiplied by t, the length of the option. What's the life of the option? Divided by standard deviation times the square root of t, the life of the option. And D2 is the natural log of the spot price divided by the exercise price plus R minus. So minus, that's the only change. Standard deviation squared on 2 times t divided by sigma root t. Never do that calculation, right? Just say D1 minus sigma root t, or standard deviation times square root of t. That will give you the same answer, much easier to put on your calculator. Okay, so that is the formula. So let's talk a little bit more about it. Okay, we need to talk about what D1 and D2 are. We'll cover this. So it was this side that was clearer. No, which side was it? We'll find out. Tell me if you can see this or not. Okay, so let's go back a little bit. Okay, that looks okay so far. Call options. Okay, so we know, so this is going to help us for something we're going to do in about 10 minutes' time. We know that the price of a call option is positively correlated with stock price movements. What do I mean by that? Well, for a call option, generically, your payoff is S minus X. So if the spot price goes up, then the payoff will go up. Yep. As this goes up, you get a higher payoff, so the price of the call option will increase. So stock prices go up, call option prices go up. And for a put option, they are negatively correlated. So for a put, it's X minus S. So as S goes up, your payoff goes down. Okay, so the put option becomes cheaper. And we've spoken about that for a couple of weeks now. So, again, this is kind of getting to what we were talking about with the Black-Scholes formula. So for my call option, payoff is S minus X. And we remember from 2 weeks ago, my lower bounds were the maximum of S0 minus XE negative RT and 0. And for my put option, the lower bound was the maximum of XE negative RT minus, it's a minus, S0 and 0. Okay, so that's what we spoke about a few minutes ago. Let's just put it down on overhead. Now let's talk about what ND1 and ND2 actually measure. So N of D1 is a measurement of the chance that the present value of the future stock price will exceed the current stock price. What does that mean? That means what are my likelihood that prices will go up? Okay, so what's the chance that prices are going to go up, prices are going to increase. ND2 is a measurement of the risk-adjusted probability that the option will be exercised. Okay, so one gives me an idea of how likely it is that prices will go up, but the second one gives me the probability the option will actually be exercised. So in other words, if it's a call option, that the prices have gone up enough to actually be above the exercise price. So ND2 is the probability that prices are above the exercise price. Okay, the option gets exercised. Everyone okay with that? So ND1 and ND2 are for call options, because with call options we're worried about prices going up. For put options we're worried about prices going down. So that's why for put options you see N of negative D1 and N of negative D2. Okay, and the reason for that is that now we know that probabilities must add up to what? What must probabilities add up to? 1. 1 or 100%, right? I have to add up to 1. So N of negative D1, remember that's for my put option, is just 1 minus ND1. So if ND1 is 80%, then this would be 20%. Okay, so remember ND1 is a measurement that prices, if you like, go up. 1 minus ND1 is, or N of negative D1 is probably that prices go down. It's just the other side of the probability. Likewise, for N of negative D2, it's just equal to 1 minus ND2. So now that's going to be the probability that prices go below the exercise price, so that a put option will be exercised. So ND2, probability the call option will be exercised. So ND2, yes, the probability the call option will be exercised. N of negative D2 is the probability the put option gets exercised. Everyone okay so far? Okay, so far it's actually quite straightforward. There's just a formula, you plug in some numbers. What we're trying to do is maybe understand it a little bit more. You can either leave here going, right, there's a formula, I'll plug it in, I don't care. Or you can go, okay, I'm going to get a job, I want to know what's actually happening here, I want to understand it. That's what I'm trying to get you to leave with, okay, by explaining how this actually works and what these measurements actually mean as well. So as I said, we don't do a derivation, but what we're going to look at is we're going to look at extreme values. Okay, so we're going to look at really, really, really in the money options and really, really, really out of the money options. So what I mean by that is let's have really, really high stock prices. That means the call option will be really, really in the money. It also means the put option will be really, really out of the money because it won't be exercised. And we'll look at really, really, really small stock prices, which means the call option's out of the money, wouldn't be exercised, but the put option is in the money, so it would be exercised. So we look at extreme values, high spot prices and low spot prices. But sorry, before we do that, I should probably show you. You find D1 and D2. How do you find ND1 and ND2? Here we go. Now, are you going to be able to see this? To me, it looks blurry. Okay, it's kind of okay. Kind of okay. So, here's the one time in the course where I do want you to round. Make it easy for yourself. Ignore this. Please, ignore this. This is interpolation. Just ignore it. You'll make a mistake. You'll lose marks. I'm making it easier for you. So with ND1 and ND2, Okay, what I want you to do is round to 2 decimal places. So you just look up to 2 decimal places. Ignore the rest of the decimal places. So let's imagine you want to look up 1.462318. What value do you look up? Round to 2 decimal points. Oh, please. What do you look up? 1 point what? Not a trick. 1.46. Okay, so we look up 1.46. So what we do is we go down till we find 1.4, and then we go across till we find the 0.06, such that this is the number that I put in for n of 1.46, 0.9279. Okay, so you just go down for the whatever point, the first decimal point, and then you go across for the second decimal point. This should hopefully be familiar from a stats course you've done. Fingers crossed. Okay. So that's what you do. You look them up in the table. Now, if it's the negative value, you could either say 1 minus that, so it's going to be what? 0.07221. Or I give you another table, which is the negative value. Right, so n of negative 1.46, I go down to 1.4, I go across to 0.06 to give me the 0.0721. Okay, so I give you both tables, so you don't have to actually subtract from one if you don't want to. If you have a quiz, it'll be a thick quiz because I will give you these and the formula. Right, so it becomes like a 4-page quiz. Okay, any questions on that? Looking it up? That's okay? Okay, so let's have a look at these extreme values. So this, all I'm doing now is following what's in your lecture notes. Don't worry. This is all in your lecture notes. Okay, so let's have a look at the extreme values. Don't know why I'm doing that. Extreme values. So first of all, what happens when stock prices become very large? So which option is going to be in the money or very in the money if we have high stock prices? Yell it out. A, fantastic. A call option. Brilliant. I'm very happy. Okay, a call option. So that means that we should not end up with 0, we should end up with a payoff. Okay, so when a call option gets exercised, right, what should I expect my payoff to be? Well, I should expect my payoff to be ST minus X, but let's put it in present value terms. So this is the lower bound we did a couple of weeks ago. I should see, maybe I'm getting too excited here, someone yell out, what should I see? Oh, I'm very excited. S0 minus E negative R. Fantastic. You're going to ace tomorrow's exam. Very good. Okay, so that is the payoff. So what is my formula for the call option premium? Black-Scholes, given to you in the exam. It's S0 times N of D1 minus XE negative RT times N of D2. Now, as I look up very, very, very big values, let's go back to this of D1 and D2. What do I notice? It approaches 1. Right, so my probabilities approach 1. Okay, so as stock prices get very, very high, excuse me, ND1 and ND2 will approach 1. So, ND1 and ND2 approach 1, right, because my prices are becoming very, very large. I'm getting high values for D1 and D2. So let's plug that into here. I say C equals S0 times 1 minus XE negative RT times 1, which gives me S0 minus XE negative RT, which is this payoff here. So good, it looks good, right? It looks good for call options when prices get very high. What about put options? Hopefully some of you are sitting there going, I know what's going to happen. n of negative d1 and n of negative d2 are going to approach. Someone said it. I'm very excited. Approach. Then you become quiet. 0, right? Because n of negative d1 and n of negative d2 is just 1 minus n d1. If n d1 is approaching 1, 1 minus 1 is 0. Brilliant. Okay, so my put options. This side. Put options. They are n of negative d1 and n of negative d2. As prices become large, these are going to approach 0, right? Because 1 minus 1 equals 0. Remember, n of d1, n of d2 are 1. So 1 minus 1 is 0, because they're the other side of the probability. What is my put option formula? It's xc negative rt times n of negative d2 minus s0 times n of negative d1. These both approach 0, so xc negative rt times 0 minus s0 times 0 gives me 0. Makes sense. When prices get high, when the spot price is way above the exercise price, I'm not going to exercise the option. It expires worthless and my payoff is 0. So if I tried to sell you a put option where the exercise price was $1 and the current spot price was $1,000, you would say no. Why would you pay for something when the current spot price is 1,000 times greater? Makes sense. Very good. Okay, so that's if prices are very high. So obviously, if prices are low, we're going to get the opposite. So if prices are low, what do we expect to happen to the call option? Prices are very low. So what's going to happen with the call option? How much should it be worth? Okay, so I try to sell you a call option with an exercise price of $20 and the current spot price is 1 cent. How much would you pay for that option? Nothing. Right, it's crazy. Ridiculous. So we expect to get a value here of 0. So we should expect that the call option is not exercised. Therefore, its value, or the call option premium, should be 0. Now, as spot prices approach 0, then ND1 and ND2, guess what they approach? 0 as well. So here's my call option formula. S0 times ND1 minus XE negative RT times ND2 gives me S0 times 0 minus XE negative RT times 0 gives me 0 as required. Okay, that's at the extremes. And then for my put options, N of negative D1 and N of negative D2, what are they going to approach? 1, fantastic. Okay, 1 minus 0 is 1. So there's going to be a 100% probability that the put options are going to be exercised. There's a 100% probability that the future spot price will be below the current spot price. So, P is equal to XE negative RT times N of negative D2 minus S0 times N of negative D1. Gives me XE negative RT times 1 minus S0 times 1 gives me XE negative RT minus S0, which is the lower bound of a put option. Okay, lower bound of my put option. Any questions? Right, so this is just trying to get you to see how this formula makes sense. We use these extreme high values and these extreme low values. Okay, but the actual operating of this is really, really straightforward. You plug it in a formula. So how do I make this tricky for you? And I do. Right, I give you a question. Okay, so you're going to yell out the answer because you all know, because I've said it already, but in 2 months' time, some of you will have forgotten, so don't forget, just in case it's in your final exam. I give you some information, right? And it's a new option, right? So this is the stuff Remember I always said an exam question where it's something you may not have covered in the course, but you've got the skills to be able to do it? This is one of those examples, okay? So it means it won't be in your final exam, probably. So I invent an option, right? I invent a new option. It's called the Canberra option, right? And I give you some information about this Canberra option. And I tell you that if stock prices increase between now and 6 months' time, you get a guaranteed payoff of $500. Please value the option. You sit there and you go, I give you some other information. I give you risk-free rates, right? I give you, well, time you know. Give you, what else would I need to give you? The current spot price. That's probably all I need to give you. What do you do in that question? How would you solve that? This is a past question I've set, right? How would you solve that? So you put stuff in the course together. That's what you do, right? And you're sitting there and you're thinking to yourself. And you go, you know what, I remember something. I remember this. Remember this. So what's Stephen asking me to do? He's saying to me, if the price goes up, I get a guaranteed payoff. Well, hey, maybe I should think about what's the probability that the price will go up. And then it clicks, ND1. That is the probability, right, that the future price is going to be higher than the current price. So what is that? That's the probability that you're going to get this payoff. Brilliant. So now you've got the probability. You've got the payoff, whatever I said it was, $50. And then you've got a risk-free rate, so you find its present value. Okay, but you've got to solve for ND1. And I'd give you all the information to solve for it. Okay, so that's an example where it's not something you've seen in the course, but hey, I've given you all the building blocks to be able to solve it. Okay, so I'm wanting to see, can you bring those concepts together, okay, in your head to try and solve for it. Okay, so that is an example, okay, of something I could do. So let me explain that again. I give you a question, and I say it's the Canberra option. And in the Canberra option, you get a guaranteed $50 in 6 months' time if the spot price in 6 months' time is higher than the spot price today. So the payoff is $50, right? That's your payoff. And then it's all about, well, what's my probability of getting that payoff? Well, hey, it's ND1. That's the probability the future stock price is going to be above the stock price today. That payoff I don't get for 6 months' time, so I need to discount it back, so I use the risk-free rate, multiply it by E to the power of negative RT as well. So it's actually not a hard question. Well, when I tell you the answer, it's not a hard question, right? But it's about putting the concepts together in the course and thinking about it. Why did Stephen 50 times in the course say the value of an option is payoffs, present value, probability? Okay, because he's going to put something in, well, A, he wants you to know it, but because he put something in the exam that kind of tested that as well. Okay, so those are sort of things I can ask you in the question, in the final exam to extend you. Right? It's not going to be that question though, obviously, because I've told you all. Right? That doesn't extend you. That says, can you remember what Steve said in a lecture? Right? But then you can start playing around with other things that we'll do in the course as well to see if that works. Okay, so let's take a break. It's what, 6 minutes to 12. Let's take a break till a bit after 12, and then we're going to go through some Black-Scholes questions, okay, and plugging them in and answering them. Okay, so we spoke about the formula. The rest of the slides here are just what we've covered already, the preliminary calculations, definition of ND1 and ND2, and then we talk about what happens when prices become very large and when prices become very small. Okay, so what we covered in the overheads before. So let's have a look at an example here. Okay, and you'll see it's quite straightforward. We just plug in the numbers into the formula. Okay, so suppose that Woodside Petroleum stock price is currently 10.50, so that's my S0, the current spot price today. Standard deviation of the return on Woodside's 30% per annum, and the riskless rate of interest is 5% per annum. What is the price of a 2-year European call option on Woodside stock struck at $8? Okay, so let's do that on an overhead. So the first thing we want to solve for when you do these questions is solve for D1 and solve for D2, because you've got to look them up and then put them up in either the call or the put option formula. So D1 is the natural log of S0 on X plus R plus sigma squared on 2 times T divided by sigma root T. So in your question, you're told the current stock price of Woodside Petroleum is $10.50. This is an option with a call option with a strike price of $8, plus my risk-free is 5%. These are all continuously compounded rates, by the way. They must all be continuously compounded rates. Plus 0.3 squared on 2, okay, times the life of the option is 2 years, divided by volatility of 30% times the square root of the life of the option of 2 years. That gives me 1.088788. You look up 1.09. Remember, you round to 2 decimal points. Okay, so I go to my table, and 1.09 is 0.8621. Okay, so that's going to be the value I use when answering this question. So ND1 is equal to 0.8621, just from looking it up in the probability distribution tables. D2 is equal to D1 minus sigma root T. So what is D1? Well, this time use all the decimal points. Okay, you only round D1 and D2, don't round in this bit. Minus 0.3 times the square root of 2 years to give me 0.66452. So 2. Or I look up 0.66. Okay, just round to 2 decimal points. So 0.66, I go down to 0.6, and then I go across to 0.06 to give me 0.7454. So N of D2, N of 0.66 is 0.7454. And then I just straight away plug it into that call option premium formula, which is S0 times ND1 minus XE negative RT times N of D2. So that gives me current stock price of $10.50 multiplied by 0.8621 minus XE, 8 times E to the power of negative 5%. Life of the option is 2 years, times N of D2, which is 0.7454, which gives me the life of the option, or sorry, the cost of the option being $3.66. $3.66. So that's the easy part, right? Hopefully the easy part. Plug it into the formula. Are there any questions on what we did here? Anyone wants clarification on? So, of course, the harder part is the next part of the question, right, or the next part of what you should do when you've got a job in the real world is, do you recommend your company buy these call options? Right? Do you recommend they buy them? They're quite expensive, right? $3.66 and the current spot price is $10.50. That's expensive. Right? You're paying, a third of the price of the current stock price to buy these options. They've got a long life though, 2 years. That makes it a little bit better. Okay. 19% per year, 18% per year. Still pretty high though. Okay, so you don't have enough information obviously to answer that question. You'd have to do a report on Woodside. What are the forecasts of what's likely to happen to Woodside's stock price? What do you expect to happen to the price of oil? Obviously the price of oil is going to impact on Woodside Petroleum stock price. So if you come up with a recommendation that you think Woodside Petroleum stock price is going to increase, okay, then maybe these call options are okay. Maybe. I'd never say yes, but maybe. I wouldn't spend that much money. Maybe that's okay, because maybe you expect the stock price to double to $20, and you're locking in to buy them, or having the right option to buy them for $8. But if your research says that you think the price is going to drop, right, then you would never recommend the company buys these. Okay, and then you start thinking about, do I suggest forwards or futures contracts? Right, do I suggest we buy those? Okay, well then I'm locked in. If prices drop, maybe that's a bad call, but at least it costs me nothing to enter into them. Well, if my company wants to buy 1 million shares, maybe I hedge 25% of the shares. So options on 25%, maybe forwards and futures on another 25%, and the other 50% is exposed to what could happen in the marketplace. Okay, those are the sorts of things you want to be thinking about and the arguments to make. Okay, you don't want to leave here saying, oh, I can plug these numbers in. You want to think about, can I now use that information to provide a recommendation to my company about what they should end up doing? Any questions? Okay, so risk covered that early in the lecture. Okay, so then you can start thinking about what are the variables in this formula, right? Well, they are the stock price, the exercise price, the time to maturity, the volatility, and the risk-free rate. And we covered these a couple of lectures ago. We spoke about if you change these, what should happen to the price of the option. Okay, and here you've got it again, right? The sort of rationale. And the last one there, which we'll cover at the end of the lecture, was it now? It's now, is implied volatilities. Right, so with implied volatilities, what you can do is, you can see on stock markets how much options are trading for. So you can actually see how the market values them. What you can also determine from that information is you've got the call option price, you know the risk-free rate, you know the stock price, and you know the exercise price, right? They're all given to you. You can visibly see the stock price today. You're told this option has an exercise price of this amount. You're told the length of time, and you can find out the risk-free rate. The unknown is the volatility. So what you can use option prices for are what we call implied volatilities. What is the market's view about what volatility is going to be like into the future, or at the moment? And volatility, remember, is a measurement of risk. So how risky is the market? So you can use this Black-Scholes option pricing formula to solve for the one unknown, which is volatility, and get a view on what the market's thoughts on what volatility would be. Okay, so you could use Excel, right, to solve for this. Because you've got an unknown on the top and bottom of the equation, right, it's trial and error. Okay, it's trial and error, so you couldn't actually solve it yourself. Well, you could, but it would take you a long time. Okay, so you've got a tute question after the break on this. Trust me, it'll never be an exam, but let's have a look at what I could do. I won't do it, don't worry. I could give you some information. So, this is implied volatilities. So a lot of the time, we do not know the volatility of a stock or more importantly, the volatility of the market. So, and in fact, we can never be certain of a stock's volatility. So what I could do is I could look at last year's volatility. What was last year's standard deviation? And say maybe that's a good guess of what this year's will be, but it will not be correct. The chances of it being correct are about 0%. Last year's volatility is never the same as this year's volatility. So standard deviation it doesn't stay the same year on year. But what I can use are implied volatilities. And that gives me what the market thinks. And remember, we all believe that markets are efficient. Okay, so hopefully it's a better guess. Okay, it's a better guess of what volatility or risk is going to be like. So implied volatilities tell us what the market believes the volatility of a stock is. Okay, what the market believes the volatility of a stock is. Because everything else is identifiable. The spot price, the exercise price, the time to maturity, and the risk-free rate. The only unknown is the volatility. Right, so you can back it out. And because the market values options, right, trades them up or down, buying and selling pressure, forces the price, it tells you what the market thinks the volatility is. So let's imagine this question. I tell you that the call option on a particular stock sells for $3.50. So that's what the option's worth, $3.50. And I say use that information to work out the implied volatility. What's the volatility of this stock? And you remember in lectures, right, Steve said something about volatilities of stock are normally around about 30%. Let's try that. Okay, so let's try a volatility equal to 30%. So you plug it into this equation, right? You know S0, you know X, you know R, you know T. All you do is change the volatility. So you solve for D1, you solve for D2, you plug it into C, and you end up with a price of $3. Not correct. What do you try next? A number higher or lower than 30%? Increasing volatility does what to the option price? Increases it. So we're going to try high volatility. So next you try 35%. You solve for D1, you solve for D2, you plug it into the call option price, and you get $3.42. What do you do now? Higher. We try 36%. You solve for D1, you solve for D2, you plug it into your option price, you get $3.49. You probably stop there, right? Close enough, and it's already taken you 20 minutes to do this. Okay? The actual number is 36.2987%. Right? If you plug that in, you will get $3.50. That would take you a couple of months. Right? So you don't do that. If you have Excel, you can solve it in a few seconds. Right? But in an exam, this is what I'm saying, I'm not going to ask you to do this in the exam, but this is what you do. You play around with volatilities. Right, to get this is what the market thinks. So this market obviously thinks this is quite a volatile or quite a risky stock. Right, a risky stock. So the people who invented Black-Scholes came up with this. Right, so this is the CBOE Volatility Index, VIX. Okay, it's also called in finance, we call it the fear index. Okay, the fear index. The higher the volatility, obviously, the more fearful the market is about what's going on. So this is just, can't see. This is just backing out with option prices, the volatility in the market. So here it is, right, all the way back to 1990. So let's look at the peak. And it is October 2008. Anyone knows what happened around then? The GFC. There you go. Look, that's the most risky point in time, and yep, makes sense. It was the GFC. No one knew what was happening. Right? Everyone was going bankrupt. Right? Then came down, then went up. Let's look back in time. 98. Anyone knows what happened in 98 in Asia? Yeah, .com crash, right? 98 to 99. So look, picked it up. There you go. Right? So you can use this, right, to look at how fearful or how bad things are in the market. So at the moment, they're kind of okay. Right? Kind of okay down here. But you can go and Google VIX, VIX yourself, volatility index, and see what's happening in the marketplace. The higher the number, the higher the graph you get, the worse things are, the more volatile things are. They normally coincide with recessions and things like that. Okay, the high periods. Periods of high market instability. Then there's a question about how do I calculate my volatilities? Okay, so do stock markets trade on the weekend? No. So Farmer and French did a study, and they assumed that because stock markets don't trade on a Saturday or Sunday, the most volatile day of the week should be the Monday. Right? Because what happens when stock markets are open? People trade in shares, and they trade on information. So every time the price of a share trades, it should represent an update in the information set. Okay, some information's come out. Earnings are down. CEOs died, whatever the case may be. No, true. There are studies. That is bad for companies normally, unless it's a bad CEO. Then it's good for stock prices. Right? So when this information gets out, that's when it gets... You can't see it in the share price unless the share market's open. The funny thing is, though, there's no real difference in volatility no matter what day of the week you're looking at. So even though the market's closed on Friday, you've got Saturdays and Sundays information. Monday's just like any other day of the week. Okay, so that got us thinking, you know what? Maybe we should just look at volatility on trading days. So let's ignore the weekends and let's ignore public holidays. Let's only focus on how information gets impounded on the days when it trades. Because I don't care about weekends, because I can't buy or sell shares or public holidays. And there's approximately 252 trading days in a year. Remove the weekends and remove public holidays when markets aren't open. And there you can work out what's the volatility per annum. Well, it should be the volatility per trading day multiplied by the square root of maybe 252, the number of trading days there are in a year. Okay, that's something just for you to think about. I'm obviously going to give you annual volatility figures, right? 30%, 20%, okay? I'm not going to give you this trading day stuff. But just be aware, that's the kind of stuff we think about. Okay, so the last thing we want to look at today is we want to think about what happens when we include dividends into Black-Scholes. So we're not going to do dividend yields today. We'll do that in the first lecture after the break. And guess what happens? This is where it gets repetitive, and hopefully it makes the final exam easier for you. We look at dividend yields with lower bounds. We prove them using the tables. We look at dividend yields with binomial, and we look at dividend yields with Black-Scholes. So we do those three topics again. Okay, so all of those, like I said, who are emailing me saying, I don't know how to do this, you haven't done it yet. Okay, so lower bounds, binomial with currencies, futures, options, you haven't done it yet. We'll do it to death after the break, and you'll be pros at it. But with dollar dividends, which is what we're looking at today, okay, how do we deal with dollar dividends? Well, a bit like we did a couple of weeks ago, wherever you see the stock price, you subtract the present value of the dividend. Okay, so our formula, wherever you see an S0 in our Black-Scholes formula, you replace it with S0 minus PVD, the present value of the dividend. Right? Okay, so wherever you see an S0 in our formula before, you replace it with S0 minus the present value of the dividend. So what did the previous lecture slides talk about? They spoke about why you do that. And they talk about you want to separate the risky component from the riskless component. Now, the riskless component here is the dividends. You know what's going to be paid. You're told their dollar value in dividends, so you're going to include them in here. So all that you're left with is uncertainty about whether options get exercised or don't get exercised. Okay, so as you see, exactly the same formula as before. All you've done is remove the present value of the dividends wherever you see an S0. So you don't get this formula in your final exam. You're expected to know how to make that change. But all you do is just subtract whatever those dividends are from the current stock price. And then the question is, at what point do you work out the present value? So those of you who have done corporate finance will know that a couple of things can happen when dividends get paid. Okay, who's here has heard of the ex-dividend date? No one, so that's good, right? So no one's got an advantage. Not that there's an advantage anyway. The ex-dividend date is a date at which, if you own the share, you're entitled to the dividend. So for example, if the ex-dividend, so let's imagine dividends have been paid on the 30th of November. Normally they go ex-dividend a couple of weeks before. Let's say the 15th of November. Anyone who owns a share on the 15th of November is entitled to the dividend. After that date, you're not entitled to the dividend. So when would you expect to see the share price drop? When it's paid on the 30th of November or the ex-dividend date on the 15th of November? The ex-dividend date on the 15th of November. Because if you buy a share on the 16th of November, you're not entitled to the dividend, so you're not going to pay for it. Right? So you'd pay whatever the stock price is less the present value of the dividend because you won't end up receiving it. So when you work out the present value here, you do it at the ex-dividend date, not at the date the dividend's paid. Why is this? Because companies need to work out who's entitled to the dividend. Because you have buying and selling all the time, right, it's better to set a date. Anyone who owns it on this day is entitled to it. And then even if they sell it after that, they're still going to get the dividend. Okay, but when they sell it after that, the price they receive for selling incorporates their receiving the dividend because the price drops by the amount of the dividend, so they're not any better off. Okay, so consider a European call option. On a stock with ex-dividend dates, so that's the ex-dividend, that's what we care about, in 3 months and 7 months. The dividend on each date is 75 cents, share price is $30, X is 29, volatility 25%, risk-free 8%, and the life of the option is 9 months. What is the price of the call option? So those two dividends, the 75 cents, the first one paid at 3 months, we have to bring it back 3 months. So we say 0.75 times e to the power of my negative risk-free of 8% times 3 months. The second dividend is paid at 7 months. So that's second 75 cents times e to the power of negative 8% risk-free times 7 on 12 gives me the present value of both dividends to be 1.451. So now wherever I see the stock price in my equations, I just subtract 1.451. So D1 becomes the natural log of the current spot price of $30 minus 1.451 divided by the exercise price of 29 plus risk-free of 8%, volatility of 25% squared divided by 2 times the life of the option, which is 9 months. Okay, so 9 on 12. Divided by volatility of 25% times square root of the life of the option, 9 on 12, to give me 0.31, plus some other stuff, but you only look up the 0.31. D2, I should have the other stuff there, I didn't, I apologise. 0.31, extra stuff, minus volatility of 25% times square root of 9 on 12 gives me 0.09. So now my call option is going to be $30 minus, that's the spot price, 30 minus the present value of the dividends of 1.451 times n of 0.31. Look it up, you get 0.6217. Minus my exercise price of 29. I don't subtract 1.451 there because it's the exercise price, not the spot price. Okay, remember when companies pay dollar dividends, we don't change the exercise price or the number of options. That'd be a good exam question, right? Giving you dividends in cash, seeing if you could change the exercise price. They'll be putting different concepts in the course together. That could be good. Okay, minus exercise price of 29 times e to the power of negative 8% times 9 on 12, the life of the option, times n of D2, 0.09, which is 0.5359, and that gives you a price of $3.11. Okay, so $3.11. And that's taking into account these dollar dividends being paid, these 75-cent dividends being paid. Any questions on that? Again, you get the base formula in the exam. You have to remember how to make the change. It's really simple for this first one. Wherever you see an S0, subtract the present value of the dividends from it. Okay, so you write that down, you remember that. And of course, if it's a dividend yield, what do you think you're going to do? You're going to say S0 times e to the power of negative the dividend yield times t. Wherever you see an S0. That's as easy as that. Okay, so even though there are changes you need to make, right, don't worry about that. We'll do that after the break. Don't write it down. All I'm saying is these are easy changes you need to make. With dividend yields, you just remove the dividend yield by multiplying it by e to the power of negative the dividend yield times the life of the option. Okay, so what have we done? We've spoken about Black-Scholes being used for European options. Last week we spoke about binomial option being used for American. So another thing I like to do in exams, final exams, is give you enough information to solve for both Black-Scholes or binomial, right? So I give you percentage increases, I could be really tricky and just give you volatility, right? So you could use the other one for solving for U and D, but I could say imagine there are 2 time steps or whatever. If I tell you it's an American, I've given you all the information to use binomial and Black-Scholes. Which one do you use? So I tell you you're solving for an American. What formula do you use? Binomial. You remember to solve using binomial. If I tell you to value this European option, you use Black-Scholes. Right? So that's just making sure, do you know when to use the right formula? American, binomial, European, Black-Scholes. Okay, so tomorrow you have your exam. I've had a few questions, right? So again, the final exams, I mean, only look at the stuff you've done, right? Don't look at the stuff you haven't done. And then what I do is I always put up the solutions at the back of the textbook. Okay, so there are a few of them that are wrong, right, unfortunately. But I always get that question, what do I concentrate on? Do I concentrate on what you've done in the lectures, the tutorial questions, or do I concentrate on the textbook? And the answer is a resounding focus on what I've done. Right? The reason I give you the textbook stuff is because people like extra questions. Right? It'd be silly of me not to give you the solutions, given if you've bought the textbook, there's 200 questions in there you can have a look at. Okay, but if you're looking at a question, you're going, oh, we haven't covered that. Well, we haven't covered it, so that means you probably don't need to worry about it. Okay, so if you see questions, though, that relate to what we've covered in the lecture, look at those, do those. But if it's stuff we haven't covered, and we don't cover everything in the textbook, right, then don't worry about it, okay, and don't stress about it. Okay, I've already told you, if you can do the tutorial questions, you can do the examples we've done in the lectures, then you're going to have no problems passing this exam. That's my point of view. You can disagree with me tomorrow, right? But that's what I strongly believe. Okay, and you'll let me know if I'm wrong. I know. Okay, but that's what I think. Okay, so if you're getting worried about questions in the textbook that you think, gee, Stephen hasn't covered that, don't worry about it. Okay, worry about what I've covered. If I'm going to, so not in the mid-semester exam, I don't do this, but in the final exam, that question like we did before, that's something that doesn't appear in the textbook. That's something I've sat down for a while and thought, how can I extend you? How can I test you? Right? Stuff I've taught you in the lecture, but can you put it all together? Okay? There'll be one of those sort of questions in the exam. The rest of them, as I said, some of them look like cheat questions, maybe a little bit harder, right? But they're, yep, that's easy. Well, not that's easy, but yep, seen that before. The other ones, yeah, I've seen those before, but gosh, why did you have to ask that? Right? I don't like that question, but you've seen it. Right? And then there's in the final exam that like fifth question or fourth or fifth question that you go, what's this? And you really have to think and put together different concepts in the course. But I promise, I've taught you how to do it. Right? I have taught you how to do it, but you need to be able to put the different concepts in the course together. Okay, so we've got plenty of time. I will stay down the front to answer any questions you have about today's topic, or if you have questions about the mid-semester exam tomorrow evening as well, please feel free to come down and ask me. Thank you, and good luck for your exam tomorrow. And enjoy your break. And just before you ask questions, please let me fix up this, and then I'll be happy to answer.